What's going on, option traders, or hopefully soon to be option traders? My name is Bo Crable, the founder of Option Scout, where we create software for options traders. And in this video, I want to talk about when options trading becomes gambling and what you can do to avoid yourself from actually gambling. Because, you might actually be like, no, I'm not gambling, I'm selling options. Well, you can actually still have the odds against your favor, even though you are selling options where you think you have a greater chance. And I'll just kind of walk you through all these things that you can do to be a more responsible options trader. Because throughout this video, like practically the point of what I'm trying to explain to you is, as an options trader, it becomes gambling when you become irresponsible. So how can you become irresponsible? Well, the first thing you can do, and I'm going to throw out a concept from the great Stoic philosopher Marcus Aurelius. So we're bringing out the Greek philosophers here, which they definitely were not option traders, but funny or not, their concepts kind of bring to real life. So there's something the Stoic philosophers would do, and it's called negative visualization. Or like negative manifestation. Or what you're trying to do is you're trying to think out in the future, but you want to think it in a negative way. So a lot of people they envision themselves succeeding and doing well, and positive visualizations, and that's really, really good, and you should do that because you want to feel like, how is that going to happen? But you also want to do that on a negative side, and not to be a negative person, not to be a skeptic, but to be prepared and to understand what you could be missing, so then those things don't happen. Like, that's the purpose of negative visualizations, and that's what the Stoic philosophers did, is they did that negative thinking and visualizing the future so they can be prepared for it. And as an options trader, you should do that. So think, okay, I'm doing this trade. Well, what could happen? Well, the Feds could announce something and stock market just dips quite a bit. Okay, yeah, that could be a thing. Okay, implied volatility could really skyrocket or could really go down. Am I protecting myself? Or maybe an announcement happens that I have not heard of, or maybe, is there an earnings play going on? So you start to think of all the things, and something you should really ask yourself to be responsible is, if you're trading options, one, just check if there's an earnings. Two, also check if there is a dividend at play, because when there is a dividend at play, your risk of getting assigned is actually higher. The next thing, look to see if there's any events going on. Why is the stock up or down? Or is Tesla having an AI day coming up? Or is there a big, obviously earnings is a thing, or was there just a big announcement? Or, what is going on with that specific stock that could be playing out right now? And just try to think of all those things that could negatively affect it. And then, once you've thought of it, do you need to do anything to adjust your trades? So, perfect example, if you're doing cash secured puts, it probably makes sense to buy a long put as well to protect on the downside, so you don't have such a massive max loss if things do go wrong. All right, so the next thing I want to talk about when options trading becomes gambling is when probability is not on your side. And now this may seem obvious, but if you're buying options, you're generally going to have a less than 50% chance of being profitable. Now, that does not mean you can't make money, and that also does not mean you won't make money, because if you do something that is not really factored into pricing of an option, is that stocks go up. All right, now not all stocks go up, but if you look at the S&P 500, it's averaged 9% over the last one amount of years. The only price point that's actually factored into a return rate is the risk-free rate of return, which is generally lower than the S&P 500 return. So anyhow, I'm not saying if you're an options buyer and you only have a less than 50% chance that no one's going to win in buying options. That's not true. However, if you're consistently investing into option trades, either selling or buying where the trades are not in your favor, then that's gambling, right? If you're buying really short-term call options that are far out of the money, that's gambling. Or even if you're selling options, or let's say even if you're doing covered calls and you're doing really, really close to at the money, and you're making money, but you're not, you might be better off than buying. Well, at that point, it's not gambling, but it's actually just really risk adverse, and that's where it becomes, again, not responsible. So just make sure the odds are on your favor. Don't be buying some crazy YOLO call options. However, that's going to segue into the next point I want to talk about, is that you want to spread out your trades. So this is a funny concept, but at a casino, your odds are actually best at the beginning, which is a weird concept. But the reason for it is because, the rule and laws of numbers, where as numbers spread out, that you get the real probability. So let's say you go to the casino and you your first little gamble, you make money. Well, your probability was actually 100%. Well, because that's all you know, you just won. So if you left, you had a 100% chance of winning. Like, that's what you did. But as time goes on, you'll realize you're going to get closer to the probability, which will be losing money, right? So let's say a slot machine has a 10% chance of making profit. Well, the casino will make more money because that odds are in their favor. But, you know, if you go there and if you win right away, if you win on the 5th time, well, you've only done 5 attempts and you made some money, so you actually have a 20% chance. But then as time goes on, you get to 10%. So as an options buyer, you actually have a better chance of succeeding in a short time period. So it's kind of crazy, right? When you hear people doing YOLO options, where practically what that is you're buying a call option or put option with a low expiration date. Technically, that has a better odds because you're gambling and your odds are not against your favor. You're better at the beginning. But as an option seller, if the odds are in your favor, so let's say you're trading options. And you're selling puts, you're selling calls, you're doing short put spreads, you're doing short call spreads, you're doing iron condors, and you have a 70% chance of winning, 80% chance of winning, a high chance. But you only do it on one stock, on the same expiration date. And let's say you have a $30,000 account, and you take that $30,000 account and you put it all onto short put spreads that have a 70% chance of being profitable. That's actually really, really high risk, and that's actually gambling, even though you have a 70% chance of winning. And the reason for that is because if the trades go the wrong way, you could lose a lot of your account. You could lose 50, 60, you could lose all of your account actually because of the fact that you're doing a small amount of trades. So yes, you have a 70% chance, but the sample size is so small. So again, you need to understand your probability, and you want to really stretch out your the numbers, pretty much the data input, the data set. So the ways you can do this by adding extra stocks. So if you have a $30,000 portfolio and you want to do some, credit spreads, it would probably make sense to, spread it across 10 different stocks, maybe 5 different stocks, maybe 20 different, The more you spread it out, the more you're going to have as a higher probability. Now, here's the thing. A lot of people are like, no, well, because then at that point, you're not going to be making as much money. Well, here's the thing. You want to get close to that probability that you're actually hitting it because, yes, if you trade, let's say, a put credit spread on Coinbase and you put all of your account onto it and you make a bunch of money, yeah, you're going to have a higher ROI than spreading across a bunch of different trades because maybe one of those trades is going to lose money. However, you also have a higher chance of losing a bunch of money. So yeah, that's what you want to do. So to recap this, have negative visualizations. Look out at the future and be like, what could go wrong? How can I protect myself? Okay? Remember Marcus Aurelius. The second thing is you want to have probability on your side. So, as someone who sells options, that gives you the probability on your side. But even though if you have the probability on your side, where now it's not as much gambling, you still want to make sure that the numbers are working for you. So spread it across several different trades, spread it across several different expiration dates, different stocks, all this thing, and just make your portfolio larger so then your numbers are actually hitting that. So, and the last thing to kind of understand is one thing I would also suggest, again, not financial advice, but options are not perfect. So, even though if you have a high chance of success, you should probably give yourself a little bit of a buffer as well. Because, even if it says 60, 70, 80, still give yourself a little bit of buffer. It just usually helps out quite a bit. But anyhow, I hope you liked this video. If you did, make sure to like and subscribe, and I will see you in the next video.